Welcome back to the Intentional Trading Channel. This is the sixth episode in the Mentorship Mastery Program, and if you are just joining us here, I strongly encourage you to pause this video and revisit the previous episodes. This program is not episodic entertainment, it is a structured psychological and strategic progression. Each episode installs a layer. Miss one layer and the architecture weakens. This channel exists to correct that. Here, we do not chase indicators, hype, or emotional conviction. We build traders who think, execute, and repeat with intention. Before we go further, take a moment to like this video. Not as a favor to the algorithm, but as a signal to yourself that you are committed to this path of structured mastery. Now stay with me closely. Most traders watching this video are frustrated, not because they lack effort, intelligence, or even market knowledge, but because something that should be working keeps breaking down in execution. You have changed strategies, you have refined entries, you have adjusted indicators, you have optimized timeframes, yet the inconsistency remains. And the conclusion you keep reaching is a dangerous one. My strategy is broken. What if that conclusion is wrong? What if the strategy was never the problem? What if the real failure lives beneath the surface, in something you were never taught to see, never trained to build, and never told was necessary? Let me ask you something, and I want you to answer it honestly, not out loud, but internally. How many strategies have you abandoned in the past year? 1, 3, 5? How many times did you say, "This doesn't work," right after a string of losses, only to see someone else trading the same idea profitably? That moment should have disturbed you, because it points to a truth most traders never confront. Strategies do not operate themselves. Structures do. And tonight I want you to sit with that, because if you misunderstand this single idea, you will remain trapped in a loop of hope, excitement, frustration, and abandonment for years. But if you understand it deeply, if it rewires how you see your trading behavior, you will realize that you may not need a new strategy at all. You may only need a new structure. Now lean in. Most traders blame their strategy because strategy is visible. It is easy to point at an entry rule, an indicator, or a setup and say, "This failed." Structure, on the other hand, is invisible. Structure governs when you trade, how you size risk, how you respond to uncertainty, how you behave after a loss, how you behave after a win, and whether your execution is repeatable or emotional. Because structure is internal and procedural, not graphical, most traders ignore it. And what the mind cannot see, it cannot correct. Here is the uncomfortable truth. A weak trader with a strong strategy will still lose money. A structured trader with an average strategy will often outperform them. That statement alone should force you to pause. If it does not challenge your current belief system, you are not listening deeply enough. Let me explain why traders wrongly blame their strategies for inconsistency. When inconsistency appears, the human mind searches for a concrete cause. Strategy offers that. It is easier to say the setup failed than to say my execution was structurally unstable. It is easier to replace indicators than to rebuild discipline. It is easier to tweak rules than to confront psychological leakage. Strategy becomes the scapegoat because it is external, mechanical, and replaceable. Structure is internal, demanding, and exposes identity-level flaws. Think about this carefully. Two traders can trade the same strategy. One executes it with patience, predefined risk, strict timing, and emotional neutrality. The other executes it impulsively, sizes up after losses, hesitates after wins, and violates rules under pressure. The outcomes will be radically different, yet the strategy is identical. So what failed? Not the strategy, the structure. Most traders never document this because they are not trained to. They do not journal structural behaviors. They journal pips, entries, and exits, but they do not journal decision quality, emotional state, rule adherence, or execution timing. So when results deteriorate, they lack data on the real variables that cause the breakdown. In the absence of structural data, the mind defaults to the most obvious suspect, the strategy. This is why many traders become professional strategy collectors and remain amateur executors. And here's where the mentorship tone becomes firm, because this is not a small error. This is the core reason why traders stay stuck for years while believing they are learning. They are learning what to trade, but never learning how to behave while trading. And markets do not reward knowledge. They reward behavioral precision under uncertainty. Let me speak directly to you now. If your strategy only works when you feel confident, calm, or emotionally aligned, it is not a strategy. It is a conditional hope system. A real trading strategy is designed to be executed consistently even when you feel nothing. That emotional neutrality does not come from the strategy itself. It comes from structure. Structure is what carries you through drawdowns. Structure is what prevents revenge trading. Structure is what keeps your risk identical on trade number 1 and trade number 50. Structure is what allows probability to express itself over time. Without structure, probability never gets a chance to work. This is why traders experience something deeply confusing. They backtest a strategy and see profitability. They demo trade it and see promise. Then they go live and everything collapses. And again, they blame the strategy. But the environment changed. The pressure changed. The emotional stakes changed. And because there was no structure to stabilize behavior, the strategy never had a fair opportunity to perform. This is not a market problem. This is a design problem. And this brings us to something very important. If inconsistency is your problem, you do not need a better setup. You need a stronger execution architecture. You need rules that govern you, not rules that describe the market. Most strategies are market rules. Structures are trader rules. And markets do not punish weak ideas as quickly as they punish weak behavior. Let me pause here and ask you another question. When you lose a trade, do you know exactly what the next correct action is, without hesitation, without emotional negotiation? If the answer is no, your structure is incomplete. When you win a trade, do you know exactly how to prevent overconfidence from leaking into the next decision? If the answer is no, your structure is incomplete. When the market does nothing for hours, do you know whether to wait, stand down, or reassess? If the answer is no, your structure is incomplete. This is what most traders miss. Structure answers questions before emotion asks them. So before we go any further in this mentorship, I want you to internalize this foundational truth. Your strategy is not failing you. Your lack of structure is exposing you. In the next batch, we will go deeper. I will break down the invisible architecture that makes any strategy repeatable, and I will show you why consistency is not a talent, a personality trait, or a gift. It is a designed outcome. Good. Stay with me. If you are still here, it means something in the first batch unsettled you. That is intentional. Real mentorship is not comfort-driven. It is clarity-driven. Now we move into territory most traders never see, let alone build. We're going to talk about the invisible architecture that makes any strategy repeatable. Not profitable once. Not impressive on a screenshot. Repeatable under pressure, boredom, fear, confidence, drawdown, and time. And I want you to listen to this part slowly. Because structure is not a checklist. It is not a routine you follow when you feel disciplined. It is an internal system that operates even when discipline is absent. That distinction matters more than you realize. Let me say something that may initially sound abstract, but I want you to sit with it. Markets do not reward intelligence. They reward alignment between decision-making and probability. That alignment does not come from strategy rules alone. It comes from behavioral containment. Structure is containment. Most traders think structure means having rules. That is surface-level thinking. Rules are static. Structure is dynamic. Rules say do this. Structure says here is how you behave when you are tempted not to. One governs intention, the other governs reality. Now let me ask you something very directly. When you break your rules, what breaks first? Is it the rule itself, or is it your emotional state? Be honest. It is never the rule. The rule was clear. What failed was your internal stability in the moment pressure entered the system. That is why strategy alone cannot save you. The invisible architecture I'm talking about consists of 3 layers. And no, I will not label them. I want you to feel them as we go. First, there is behavioral predictability, not market predictability. Your predictability. Can you accurately predict how you will behave after 2 losses? After 3 wins? After a missed trade? After a slow session? Most traders cannot, and that alone disqualifies them from consistency. If you cannot predict your own behavior, probability has no stable vessel through which to operate. Professional consistency begins when your behavior becomes boringly predictable. Think about that. Boring. No emotional spikes, no heroic recoveries, no dramatic collapses, just repeated, almost uninteresting execution. That does not happen accidentally. It is designed. Structure defines what you do before, during, and after a trade, regardless of outcome. Without that, every trade becomes a psychological experiment and your account becomes the testing ground. Now listen carefully. A strategy tells you where opportunity exists. Structure tells you when you are allowed to engage with it. Most traders invert this. They see opportunity and then ask themselves whether they feel ready. That is backward. Structure decides readiness before opportunity appears. This is why many traders sabotage good setups. The setup was valid, but the trader was not structurally aligned. Maybe risk tolerance was compromised. Maybe emotional residue from a previous trade was still active. Maybe fatigue was present. A structured trader does not negotiate with these states. The system either permits execution or it does not. And here is where many of you will feel exposed. If your decision to take a trade depends on how confident you feel in that moment, you do not have structure. You have mood-based execution. Mood-based execution cannot be consistent because moods are not stable variables. Probability requires stable inputs. Structure stabilizes the trader so the strategy can express its edge. Let me put this another way. Structure is what allows you to execute the same decision quality on a good day and a bad day. Without it, your performance is emotionally seasonal. Some weeks you feel locked in. Other weeks you feel disconnected. Markets do not care about your internal seasons. They respond to repetition and alignment. Now, there is something else traders misunderstand about structure. They think it restricts freedom. In reality, it removes internal conflict. And internal conflict is the most expensive thing in trading. Every time you hesitate, second guess, override, or chase, conflict is present. Structure eliminates that by pre-deciding behavior. You are not deciding in the moment. You are executing a prior decision made in clarity, not pressure. That is why I always say this in mentorship. The trader you are during execution must obey the trader you were during preparation. If you reverse that relationship, emotion will always win. Let me ask you another uncomfortable question. When you sit down to trade, do you already know how many trades you are allowed to take? Or do you see how the session goes? Be honest. Seeing how it goes is not flexibility. It is structural absence. It opens the door for overtrading disguised as opportunity. Structure does not adapt emotionally. It adapts procedurally. And this is where most traders get stuck. They believe structure means rigidity, that if they build structure, they will miss opportunities. What they do not realize is that unstructured flexibility is what causes them to miss consistency. Structure does not remove opportunity, it filters it. Think of structure as a lens. Without it, everything looks tradable. With it, only specific conditions pass through. That selectivity is not limitation, it is precision. Now I want to talk about repeatability, because this is the heart of it all. A strategy that cannot be repeated under stress is not a strategy. It is a theoretical idea. Repeatability requires that execution does not depend on motivation, confidence, or emotional clarity. Those fluctuate. Structure does not. This is why traders often say, "I know what to do, I just don't do it." That sentence reveals everything. Knowledge is present, structure is absent, and markets do not pay for knowledge. They pay for obedience to process. Let me slow this down. Structure decides position sizing before emotion wants to increase it. Structure decides stop placement before fear wants to widen it. Structure decides trade frequency before boredom wants to create action. Structure decides disengagement before ego wants revenge. Without those pre-decisions, you are not trading a system. You are negotiating with yourself in real time. And that negotiation always favors emotion. Here is the paradox most traders never resolve. They want freedom in the market, but they resist the discipline that creates it. True freedom in trading is not the ability to do anything. It is the absence of internal chaos. Structure creates that absence. Now, I want you to reflect on something quietly. If I removed your strategy today and left your behavior unchanged, would your results meaningfully improve if I gave you a better one? Or would you eventually sabotage it the same way? If the honest answer is the second, then you are finally seeing the real issue. Structure is transferable. Strategy is not. A structured trader can move between strategies and remain stable. An unstructured trader will break every strategy they touch. This is why mentorship focuses on the trader first, not the system. Let me say this clearly, because this is a doctrinal position of this channel. Consistency is not achieved by finding the right strategy. It is achieved by becoming the right executor, and execution quality is governed by structure. In the final batch, we will take this from understanding to application. I will show you how restructuring your approach can revive a system you may have already abandoned. I will show you why many failed strategies only failed because they were never given a stable operating environment. Stay present. This is where everything converges. If you have listened carefully to the previous batches, something should already be shifting in how you interpret your past trading history. Trades you once labeled as bad strategies are beginning to look more like structurally unsupported executions. Losses that felt random are starting to reveal behavioral fingerprints. This is not regret. This is clarity. And clarity is the foundation of redesign. Now we move into the most dangerous and most liberating phase of this doctrine: restructuring your approach without abandoning your system. Because here is a truth that many traders resist at first. You do not need to throw your strategy away. You need to rebuild the environment in which it operates. Most strategies do not fail because they lack edge. They fail because they are deployed inside chaotic behavioral systems. No edge survives chaos. Let me speak directly to you now, not as an educator, but as a mentor. If you have been trading for any length of time, you already possess more than enough information. You know entries, you know exits, you know risk rules. What you lack is not knowledge. It is containment, and containment is structural. Restructuring your approach does not begin on the chart. It begins with how you govern yourself. And this is where many traders make a fatal mistake. They attempt to improve execution while reminding the same internal identity. But identity precedes behavior. If you see yourself as a reactive participant, your execution will always bend toward reaction. Structure is how you reauthor identity. Let me slow this down. A reactive trader asks, what is the market doing? An intentional trader asks, what am I allowed to do now? That single shift changes everything. Restructuring means you stop designing trading rules for the market and start designing operating rules for yourself. You stop asking whether the setup looks good and start asking whether you are structurally cleared to engage. This is not restriction. This is command. Here is how revival actually happens. You take a strategy you once abandoned and you place it inside a new behavioral framework. Trade limits are no longer optional. Risk parameters are no longer negotiable. Engagement windows are no longer emotionally driven. You decide in advance when you trade, how much you risk, and when you disengage. And then you obey that design regardless of outcome. At first, this will feel uncomfortable, not because it is wrong, but because it removes the illusion of control emotion gives you. Many traders are addicted to the feeling of doing something. Structure deprives impulse of oxygen. That deprivation feels like loss before it feels like power. But stay with it. When structure is installed, something remarkable happens. The emotional noise reduces, the urgency fades, the need to recover losses disappears. Trading becomes quieter, and in that quiet, probability finally has space to work. This is why structured traders often look unimpressive in the moment. They do not chase, they do not force, they do not react. But over time, their results compound while others oscillate. Now let me address something critical. Restructuring does not mean perfection. It means repeatability. You are not trying to eliminate losses, you are eliminating behavioral variability. Losses are part of the system. Behavioral inconsistency is not. Think about this carefully. If you lose 3 trades following your structure, you are still winning at the identity level. You executed correctly. Probability simply has not expressed yet. But if you win a trade by breaking structure, you have already lost something far more important than money. You have reinforced chaos. This is the psychological trap that destroys many traders. They reward outcome instead of process. Structure reverses that. Process becomes the metric. Outcome becomes data. And this is where confidence is rebuilt properly. Not the fragile confidence of recent wins, but the deep confidence that comes from self-trust. You begin to trust yourself because you do what you said you would do. Over time, that trust stabilizes execution, and stabilized execution allows edge to surface. Now listen to this next line carefully. This is not motivation. This is doctrine. Your account does not grow because you are right more often. It grows because you are consistent more often. Consistency is not emotional strength. It is structural alignment. This is why many traders experience a strange phenomenon when they restructure. Their win rate may not immediately increase, their profits may not immediately explode, but their drawdowns reduce, their stress reduces, their decision quality stabilizes, and those changes precede profitability. Always. You cannot shortcut this phase. Restructuring is not exciting, it is not flashy, it does not sell screenshots, but it builds traders who last. And now, I want to pull the lens back and leave you with something larger than this episode. Everything we have discussed today extends beyond trading. Structure governs performance in every domain. Where structure is absent, chaos eventually appears. Where structure is intentional, consistency becomes inevitable. That is the philosophy of this channel. We are not here to create lucky traders. We are here to build intentional operators. People who design their behavior first and then allow systems to remind them. So as you step away from this episode, do not ask yourself whether your strategy works. Ask yourself whether your structure exists. Ask yourself whether your behavior is predictable. Ask yourself whether your execution is governed or negotiated. Because the moment you stop negotiating with yourself, the market stops feeling like an enemy and starts behaving like a system you can engage with clarity. This is the sixth doctrine in the Mentorship Mastery Program. It is not meant to be consumed once and forgotten. Revisit it, reflect on it, let it confront you. And if this episode shifted how you see your trading, stay close to this channel. What comes next builds on this foundation. The next doctrine will take us deeper into intentional execution and the mechanics of maintaining structural integrity over time. I look forward to seeing you there. Until the next doctrine, remain intentional.